Contrasting Viewpoints with Ray Sclafani and Mark Hurley.
Ray has been one of the leading consultants in the financial services industry for many years, and Mark has annoyed countless people throughout the wealth management industry over the last 25 years with the white papers he has written. Today, they are going to provide their insights into what is really going on in the industry, some of the more absurd things they've seen, and also for anyone in this industry, some issues they should be thinking about as they try to build their business.
All right, welcome back, everybody, to today's session of Contrasting Viewpoints. I'm excited to be joined again by my good friend Mark Hurley, a longtime industry observer and provocateur who's never afraid to challenge conventional wisdom. I'm Ray Sclafani. I'll be your co-host. Mark, it's awesome to be back with you again today.
As always, it's great. Looking forward to it.
All right, so we're going to explore today some of the most pressing forces reshaping our industry, from the coming advisor shortage to the rise of AI. There's been some great survey being done and some data that we'll share with you. We've got the consolidation of firms to the shifting demands of high net worth clients. These aren't just headlines, everybody. They're trends that are going to define how advisors build enduring firms in the next decade. I think you'll also really be interested in You've Got to Be Kidding Me, our favorite segment in our episode each month. We're going to be also joined, our main event today, by Kevin Knull, who many of you know ran Money Guide Pro before it was sold to Envestnet. Kevin's often the guy that is hired to fix things broken or grow businesses faster. And as CEO of Tax Status, which was started 8 years ago, and Kevin became the CEO a little bit more than a year ago, I think you'll really be interested to hear the problems they're trying to solve as it relates to the massive shortage of advisors and CPAs and where humans and AI intersect to provide greater value for clients. If you're just using the last 3 years of tax returns to build plans for clients, you're missing the mark. And we're going to get into a pretty interesting conversation with Kevin. Mark has promised to ask all the tough questions, and I'll try to be polite to make sure Kevin wants to come back. All right, Mark, you ready to go?
Let's go.
Okay, so the first article comes out of Financial Advisor magazine, the RIA survey and ranking in the AI wars. You've all heard the numbers. 38% of advisors, which actually control 42% of total industry assets, are supposed to be retiring in the next 10 years. And the profession's going to be short 100,000 advisors by 2034, according to McKinsey. And yet the consulting firm also says that revenues coming from fee-based advisory relationships are growing and surged from $150 billion in 2015 to $260 billion in 2024. So a huge increase is already coming, and there will be more demand, yet fewer advisors. Mark, what's your take on what you're hearing here, and what does it really mean to our profession and those running businesses today?
Well, one, this is a great survey. If you're in the industry, you should go to the Financial Advisor magazine website and look at it. They do fabulous things. It's a large sample. It's about 366 firms that participated in it, including about 250 that were over $1 billion in assets. So it covers the full range.
It's a real survey.
Yeah, it's about 1/6 of them have outside investors. The rest are completely independent. And they give a lot of interesting pieces of information. I mean, I think the author's conclusion here, which is hard to dispute, that is, if we're going to have a major labor shortage in the industry, you're going to have to get a lot more automated to be able to fill that gap. And AI is going to play a very key role in doing that. They even sort of say, is this going to look like Arnold Schwarzenegger, the Terminator, going, I'll be back with your plan? I don't think it goes quite that far, but I do think that one of the things they also emphasize is that as firms get bigger, to get any kind of material growth rate, you have to bring in increasingly larger numbers of new clients. In other words, if I have 100 clients, I want to grow 5%, that's 5 clients I got to bring. If I have 1,000 clients, I got to bring 50. I mean, the numbers start to just explode as you get bigger and bigger. And so AI is going to play a really critical role in improving the efficiency of your marketing, figuring out who to target, how to get to them, et cetera. The other thing is,
no, on that point too, Mark, it's interesting. Dave Welling, the CEO of Mercer Advisors out of Denver, says part of this consolidation is the creation of so many giant players. Growing 10% is a lot easier when you're $200 million in assets, but if you're $70 billion, it means 10% growth requires $7 billion in new assets each year. that's going to require a whole better tech efficiency as you're seeking to grow at these bigger rates and the firms get bigger.
Yeah, I heard Jim Kane of Wealth Enhancement Group speak about this once, and he says, right now, until we can get those things in place, the single biggest determinant of our profitability growth is the market. That literally it's just the market up or down and we're sort of riding along. I didn't use those terms, but it's so hard when you get to that scale. And so that's why I think you're going to see immense investments made in technology. And even if you're running a smaller firm, let's say you got a couple $2 billion of assets under management, it's as equally a daunting challenge to go from adding, we were adding 20 clients a year to all of a sudden having to add 200 is unbelievably hard because you have far limited resources to work with.
Well, Dave DeVoe also was quoted in the article, I thought, quite wisely. He said he uncovered this major decline in organic growth a number of years ago. He said from 2017 up through 2022, he looked at the data and he noticed that advisors cut their business development and marketing budgets by 50%. 50 over the course of those 5 years.
Yeah, well, when you turn the lights on and the EBITDA goes up 20% a year simply for showing up because the market's going up so much, hard to get focused on that. Look, we talked about this last month in our call, but McKinsey has a study out that's showing that the population of people who are potential clients is growing substantially faster than the population in general. And so this is like the greatest potential pie-eating contest sitting out there waiting for people to go after. Now, at the same time, we are starting to see at the margins some forces come in. I mean, look, the S&P since I put out that paper a year and a half ago, 2 years ago, is up 41%. So everybody's doing great. Everybody's a genius. That said, we are starting to see the first inklings of the types of competition we thought we'd see. One of the things was interesting in this is they list all these services that are being provided now by these firms, and the numbers of services are exploding, many, many faster. And the two ones that jumped out at me was, number one, two-thirds of the clients, when they're offered tax planning, use that service. The other one is personal cybersecurity. Of the firms that offer personal cybersecurity services, which isn't a lot, 50% of their clients actually take advantage of those services. So I think you're going to see more and more firms have to do that because at some point it's going to become generic and standard if you're going to be in the business.
Well, I also appreciated in the article Peter Mallouk's quote. He's the president and CEO of the Overland Park, Kansas-based creative planning, if you didn't know. He says AI is going to be important for both advisors' internal operations as well as business development. He said, quote, I think also some firms have been able to use AI as a search function internally and also on websites where they're dealing with a lot of clients that might be 401k participants or something like that. So it's allowed for more efficient advice.
Absolutely.
That seems to be a growing opportunity for advisors.
Yeah, I mean, well, anything Peter Mallouk says, I want to listen to. He's kind of like the old, E.F. Hutton speaks, everybody gets quiet. Peter's similar. But he's right. I mean, there's just so many moving parts out there. You're either going to get much better ability to manage information and process information, or you're going to be fundamentally at a disadvantage.
Okay, so let's move on to our next article. Comes right out of wealthmanagement.com. Cerulli, high net worth client market to grow to $30 trillion by 2028. So Cerulli's finding that advisors are providing more wealth-related services as the percentage of the population with 5 million or more in investable assets increases. As wealth in the U.S. becomes more concentrated at the top, financial advisors may start acting more like family offices in providing, quote, white glove services to meet clients' more complex financial needs, according to this latest report, which, by the way, is worth reading. So Alex Ortolani, senior reporter at wealthmanagement.com, really highlighted something that's important, I think, for the industry to pay attention to. This new data around high net worth clients is expanding and growing. What's new here for you, Mark?
Well, for starters, there's always been this sort of market inefficiency that you can do the same stuff for the $1 million client that you with a $5 million client, you also do for the $1 million client. And for a long time, people got away with it. You get paid 3 or 4 times as much money for literally doing the same stuff you do for a $1 million client. The market's catching up. That's what this really highlights. And this is clearly, Cerulli did a great study here. They're pointing out that in 2024, on average, high net worth clients, and they're defining it again as 5 million more or investable assets, are being offered an average of 12 services. And that's up from 10 in 2017. This is only going to grow, but more importantly, the depth and quality of these services are going to have to get much more sophisticated. I was working on a presentation the other day, and I went and took snapshots of some of the major aggregators' service offerings, and the number of services that are being offered is just exploding. There's one that's even offering like aviation services for their higher net worth clients. So you're either going to have a more complete offering, or it's going to be hard to capture some of these clients, and it should be. If you're getting paid, I don't know, let's say theoretically 1% on $1 million client, you're getting $10,000. A $5 million client, say, pays you $40,000. You should be doing commensurate incremental value for the extra $30,000 if you believe that markets do ultimately move towards efficiency. This is what this is signaling. Everybody wants to get these larger clients. It's a massive opportunity.
I would shout out to Jamie McLaughlin, who's one of the co-founders of the Ultra High Net Worth Institute, that has done a fair amount of research on what do the affluent and ultra affluent really want. And if you head to that, we'll put it in the show notes, the ultrahighnetvworthinstitute.com. They've got a tremendous amount of research around this topic, some really good displays that help you think about what does multifamily office, single family office services look like for the high net worth. But here's the trick. Here's what we're noticing, Mark, at ClientWise and the firms that we're coaching is they're starting to look more family office-ish for the mass affluent and affluent, not just the ultra high net worth. And that's a shift that's taking place. At least we see it in the folks we're coaching.
Well, you may recall the original paper that I wrote 25 years ago. We said ultimately these firms will evolve into multifamily offices for the semi-affluent. The question is which services would make sense for the clients. And so we've had so many clients coming in and the market going up so much, people really haven't had to evolve that much. Now the capacity is starting to catch up, and we're starting to see firms realizing there's so much enterprise value they've been created that firms, even though they have plenty of opportunities to come in, they're trying to grab more and more market share by expanding their services. And this is only going to accelerate. I also think the services are going to have to get much more sophisticated. And if there's any service that I believe will be one that'll be a gating item, it's going to be tax. You're going to have to do much better on tax.
Kevin Knull will get into that with us here in just a minute. And it's not about jet refinancing or art valuation or bill paying or dog walking. It's going to be more about helping clients mitigate those taxes and how to use smart intelligence to do that efficiently in the future. Okay, let's move on to the next article. It's really interesting. CityWire reported the end of August, just last week, as we're recording this today, that MAI Capital Management is acquiring a $27 billion Evoke Advisors. The deal is one of the largest combinations of RIAs in recent memory and is expected to close in roughly 30 days. As I was reading this article, Mark, I was reminded about your prediction in Welcome to the Jungle, as you said, was written about 24 months ago. This is an example of a big firm positioning itself to capitalize on growth of the high net worth. You're talking about 13,000 clients versus Evoke, which was 27 billion, almost the same size, but with only 1,000 clients. And so you've got a really interesting merger that's taking place and is likely going to reshape the RIA industry and maybe set the pace and tone for what's to come.
Yeah, I mean, MAI is a phenomenal firm, and they pioneered working with athletes long before anyone else did. I mean, a great business based in Cleveland. This acquisition was originally a bunch of ex-Goldman Sachs high net worth brokers. The LA office of basically of Goldman Sachs went out and set up. And then some of those guys before had been at Bel Air. Bel Air got sold, and some of them left that and joined this entity. Well, they sold the business to First Republic for about $125 million back in 2012. And then we all know what happened to First Republic with some of the excitement in the financial markets. And so they went back and they started Evoke instead. Now, they're taking half of this in cash, half of this in stock. So I'm sure it'll be, and it's in California where their non-competes are probably not worth the paper they're printed on. So it'll be an interesting challenge as part of the acquisition. But it does highlight the fact that there is this tremendous opportunity to get $5 million and above clients. And this firm's positioning itself really well to try to take advantage of that.
Yeah, so more to come and more deals to come, it seems like, in the future. Okay, let's move on to the next article. This comes out of CityWire as well. Rich wrote, over 230 advisors have left Commonwealth since the LPL deal. Now, this one's interesting. It should probably catch everybody's attention. More than half of the advisors who've left Commonwealth Financial Network in the last 2 years have done so in the 4 months plus since the firm announced its sale to LPL. The data was provided directly to CityWire by Advisor Pro, and they show that Commonwealth has lost over 230 since this new news formally broke of the company's sale on March 31st. So there was a lot of folks questioning what's the trend going to be? Will all the Commonwealth advisors move over to LPL? And this kind of suggests kind of an interesting shift. Marks one of the first quantitative indicators of how LPL's acquisition of Commonwealth is being received by 2,900 advisors coming out of Commonwealth. And this is important because in the earnings call, Rich Steinmeier maintained the company's confidence in the independent brokerage giant's going to hit its goal of retaining 90% of the Commonwealth advisors through the deal. Just curious, Mark, if you've heard anything more about this story and what the real trends are.
Well, yeah. I mean, I think this is just illustrative of the challenges of M&A in a space that, one, there's a shortage of labor. And so everyone's trying to grab bodies. And the minute a deal happens, people come in and try to grab them. And two, this pesky 13th Amendment of the Constitution, which makes it hard to handcuff people to organizations without using a lot of money. In fact, I think they talked about that they're pitching all kinds of financial incentives to people to stick around. That said, it'll be fine. Maybe they don't get 90%. Who cares? It'll be fine. There's some differences in culture between the two organizations. But what I do see happening, there are many firms out there that I'm very familiar with where they have limited term restrictive covenants associated with the transaction and the money that was paid. And I expect within about a year to 2 years, you're going to see a lot more movement between parties and a heck of a lot more litigation.
Okay, so let's move on to our favorite segment. You've got to be kidding me. Okay, now, if you're listening to this, you got to follow the bouncing ball here on this article. This one's sort of double check and check again. And let's go back in time for a moment. In RIA Biz, January 26th of 2015, Brooke Southall wrote, new robo-advisor aspiration gets ex-eBay head as backer. And you follow this article through. You've also got Wired magazine. So Mark's wanting to pick not just on RIA Biz, but Wired again this month. November 11th of 2014, you've got this wealth gap in America's ever-expanding void. The rich are getting richer. There are infinite reasons why this inequality is happening. There's a tale of two cities when it comes to investments, and this new company Aspiration aims to change that, blah, blah, blah. So you've got all this happening at the same time, interestingly enough, back in 2014. Jeff Benjamin from Investment News starts digging in. He says
journalist.
Real journalist. He said, okay, they're all journalists.
No, a real journalist.
Okay, so if nothing else, Benjamin reports the founders of Aspiration Partners, a new online asset management platform. This is dating back to 2014. Got the name right, he says, but it appears to be throwing everything at the wall to see what might stick. He says it begins by touting a yet-to-be-launched mutual fund, Aspiration flagship that encompasses virtually every hot button issue in the asset management space. And he's really digging in and saying something's wrong here. We should all be paying attention. And then what was recently published? Bankruptcy. Aspiration filed for Chapter 11 protection just recently. There's an estimation of $170 million in outstanding debt, according to court filings, and an accumulated net operation loss of $580 million for federal tax purposes. In other words, what was glossed and overlooked back 10 and 11 years ago is now today filing for bankruptcy. And you've got to be kidding me. How did everybody miss it for the last decade?
Yeah, and one of the founders has a criminal complaint alleging he conspired to defraud investors. And there have been some pleas submitted, including guilty pleas involving the transfer of money. Look, this is my criticism of some of the publications that are out there. They're so desperate for eyeballs, they effectively become PR agencies for any new thing coming along. They don't act like journalists. They aren't skeptical. They don't ask real questions. And then when something bad happens, they don't bother to report on it till way, way much later. For example, all this stuff really hit the fan back in March and didn't even show up till August in RA Biz. Wired hasn't even mentioned this. And look, the job of journalists is to ask questions, tough questions. They're not supposed to be loved. They're supposed to explain stuff. This thing was so insane that at one point they were putting their logo on Clippers jerseys. How many wealth management firms have even thought about something like that? And the whole idea was, how do you build a ton of hype? If you read the original article that RA Biz had, they told the life story of the founder and why this was almost certain to be successful. Wired made it sound like they were saving humanity against rich people. But if you compare that with, say, which is a good example of what Jeff did, who's a really good journalist, he starts going, wait a minute, none of this makes sense. What's happening here? And so it makes you wonder that whenever you read some of these articles, and I remember one that RA Biz wrote on someone they liked who was going to go out and raise a private equity fund, which happens every day, and they did a full headline, full page hagiography on why this will be successful. Of course, the guy had never raised money, it never took off. Everything can't be a 15 on a scale of 1 to 10. It's got to be somewhere between 1 and 10.
All right, terrific. Mark, let's get to our main event. Let me reintroduce Kevin Knull. Kevin is the CEO of taxstatus.com. You can find them at www.taxstatus.com. Kevin, welcome to our show, and thanks for joining Mark and me in what will be a lively discussion about the big problem that you and your firm are trying to solve for our industry.
Well, thank you so much for having me.
You got it. All right, well, let's get into it. Let's start right there. This comprehensive client financials straight from the source of the truth, the IRS. Tell us a little bit about your company and why it's really important in the eyes of the advisor today.
Well, I think the biggest thing is that we provide very efficiently a means for advisors and tax professionals to obtain data on behalf of their clients straight from the IRS. So historically, most firms leverage, let's say, the last 3 years of tax returns. And they ask the client in the onboarding process or the financial planning process, give me the last 3 years of tax returns, and I'll go ahead and render advice based on that. The problem is often the tax return is incorrect, and it's not the source of truth. At the end of the day, all the 7 million other reporting sources that are sending data into the IRS is really the source of truth. The custodians, the banks, the employers, the casino winnings, all of those are being reported all the time. And we're able to provide back to the firm that's requesting that data on behalf of their client, all of that information. And it's a lot of information. And so not only what the client reported, but everything else gives you a much more complete picture.
And don't you make it easy for them to onboard the information? In other words, you've set up the technology so that you can grab all this info, get it into the right spot with the client's file, and then so the advisors can actually not just have the data, but access it and analyze it.
That's correct. We go and obtain that data and then provide it back via API. So that renders or allows many, many use cases. But the process to onboard is about a 60-second process for the client or the prospect to provide consent. So once that consent is received, we go to the IRS, we pull the data back, and we can share that in a number of ways, including that API.
Kevin, is this unique to advisors today? Is there any other way they get this information, or is Tax Status really a unique solo player in the space?
Well, we're fortunate that we really are the only firm at this point that's not only been able to connect and obtain all this data from the IRS, but keep it connected so that we can keep updating it as new information flows to the IRS, attached to that client. So the K-1s, the W-2s, all the new pieces of information are being reported all the time. And so, what we've been able to do is build that direct connection, keep it connected even when things change and even when new information is received, so we can keep providing that Delta file and provide those updates. And that allows us to do a lot of very interesting things, such as we can notify you if there's fraud activity on your IRS record, if your client maybe was flagged for an audit, that might show up in advance. All those notice alerts that are coming via mail to a CPA or to the client directly, we're receiving it as soon as it's logged into the system, which allows the advisors and tax professionals to be a little bit more proactive instead of reactive.
Why do you think advisors haven't addressed this issue yet? If the information's available, if clients can give them permission to get access to this information, why do you think this hasn't been a bigger issue or addressed so far? Like, why is this something so new that your firm's able to step into and help these advisors with?
Well, we've been doing this about 8 years, but the company was focused as a horizontal solution. So we were being used to help with the underwriting and mortgages and commercial loans. We were being used with small banks for, income verification and lots of other use cases. It's only been a little over a year that we really narrowed the focus just in wealth and tax. And, once you hear the story and you see the information, it's sort of the light bulb goes off, but we just haven't really spent the time and money to market broadly yet. We're currently onboarding lots of firms in this process.
Mark, why do you think advisors haven't addressed this yet? This is so interesting to me.
No, look, as we talked about earlier, I don't think they've had to, and now they're starting to get forced to. There's clearly also a big issue as being a fiduciary. If you're really a fiduciary and doing your work, what you do is you want to collect all the information so you can give an informed solution. And unfortunately, because a lot of firms don't have an easy way of collecting the info and the client doesn't have an easy way of gathering the info, it's almost like I'm going to work on this wing of the airplane and we'll sort of ignore the other wing of the airplane and hopefully the whole thing flies without this information. And what I find fascinating is, one, how long people have been able to function without collecting this. And yes, everybody lies to everybody except the IRS, because that once you go to become a bad man's girlfriend very quickly. But that you guys have found a way to
Your analogies are just make no sense to me. I don't even know what you just said. It doesn't make sense.
You go to jail, Ray. You go to jail, Ray. Okay, you got it.
Man, right. Oh man.
As people are learning very quickly, IRS you should be afraid of. Be very afraid of. Every morning, get up. Be afraid. I used to have a tax lawyer working for me in my last company, and he told me he always prepaid in excess amounts all of his taxes, just because he was so scared of seeing what they could do to people. That's it. What's great about it, sounds like what you guys are doing, is you have automated the function of correctly gathering all this information and then providing it so that if I'm the advisor, I quickly get this top-down view and I can see everything that's going on in the account for this client in terms of where all their assets are, where all the flows are, et cetera, et cetera.
Well, and there are a lot of reasons why clients don't share all the information with their advisors, right? They might have 3 advisors, so they're diversifying across advisors. Maybe they don't trust that advisor because it's a new relationship. More commonly, maybe they just don't remember, right? Especially the high net worth and ultra high net worth clients. They have so many accounts and so many things. They just don't remember where they are. Maybe the one spouse doesn't want to share that with the other spouse, that some account exists. There's a boatload of reasons that the clients don't share information. But as you said, the advisors, if they're going to act as a fiduciary, I just don't know how you act as a fiduciary if you don't know where all the money is. Because that recommendation, if you only know a third of the money, which is kind of typical, recommendation may not be the best recommendation. It's
not just where the money is, it's where all the assets are. And not just assets in dollar terms, but all the real estate, the lottery winnings you mentioned earlier, which is money, but
I hope
also
someday, yes.
Yeah. Well, tonight there's a drawing for $1.1 billion. So.
Yeah, bad news. I'll be winning it, but go ahead.
Okay, very good. So, but I mean, Kevin, all kidding aside, the real estate assets, the business assets, all the K-1 filings, like you make a really important point. It's not just about the money; it's about all the other assets.
So we're all seeing the hype about this big wealth transfer that's coming, right? This massive
It's
once in
not
a lifetime
coming. Yeah.
general.
No, no, no.
Yeah, which I don't believe will be.
Yeah, I don't
think
believe that. It's
we're going to
happening.
live long
It's
and
already
spend it all,
happening.
have a good time. But
Yeah,
yes,
I'm going to challenge. I'm going to maybe put something out that's probably provocative here. Is that I don't think the real wealth transfer is going to happen because parents are passing down their brokerage accounts or IRAs. It's going to happen with all the businesses and the trusts and the property. That's where wealthy people put their money, are in entities, right? They don't want to personally hold it, and they're held inside of trusts. And most advisors aren't paying attention to these businesses, but those are the windfall events, right? The businesses and the properties and the assets that are being distributed from the trust. That's the real wealth. And I think our industry has missed this because they can't get paid on the business, right? So
yeah,
they don't pay attention to it.
Some of the smartest firms, candidly, are building expertise internally to serve as an advisor, not just on the investable assets, but also on the businesses. And if you don't have this information, how do you do that? It's also I can't figure out how you would do that.
Yeah,
Now,
so the advisors don't have access. It's difficult for the clients to provide it. They may have multiple advisors, so they don't disclose equally to all those advisors. These are all really good points.
Now, when we talked about this earlier, I was surprised by how inexpensive the service is. So, for example, let's say I got $1 billion firm and I got 400 clients. What would this cost me if I would added this service as part of what I do?
Well, it really just depends on the complexity and some of the other things we're doing. But at the, right out of the box for our standard 3-year contract, it's $60 a household. I mean, it's nothing. It's
so
a rounding
24
error.
grand a year, you can go from having, at best, incomplete information to having fully automated, regularly updating, collecting information that's complete.
And what does the client have to do? What does the client have to do?
The client simply has to provide consent, which we can do with a form, but more commonly, we do it digitally. So the advisor of the firm sends a link, puts a link in there, an email or on their website or what have you. Client clicks the link, authenticates that they are who they say they are with ID.me or a driver's license and a selfie. They provide an electronic signature that gives us permission, and we go to the IRS and get the data. I mean, a minute, maybe 2 minutes max is all it takes for the client to provide consent.
And then with the open API, a regular steady stream of updating that information as it's coming in.
Now, our clients are our listeners, all the advisors, they're paranoid about, of course, data being out there for their clients. And there's a high anxiety about, oh my God, you're going to have all their financial information on your system. Help me explain to them why they shouldn't worry about that.
Yeah, so we have to take the data security seriously at all levels. So, not just infrastructure, but software, people, data, processes. We are SOC 2 Type 2 compliant, which means that our data and our systems are continuously monitored for security and availability and confidentiality. And all of that is, in with respect to the relevant laws and regs and security.
And all this data is encrypted that you're keeping too, constantly
Correct.
encrypted, and it's cloud-based.
Yes. And what's interesting is, you all have probably seen all of the data breaches that have been happening. Every day there's a new data breach announced. That's your business, right, Mark? So, National Public Data Court was a massive one here a little over a year and a half ago, whenever that was. And we've seen, 5 or 6 just in the last month or two. Because we have this direct connection to the IRS, we can monitor the IRS record, and that social security number is so critical, right? You can do a lot of damage when you have somebody's social security number. And as you probably say, Marky, I think everybody just needs to assume their social security is now available to the bad guys everywhere.
Yep.
But think about all the damage you can do if you have that social security number. That bad guy can file for Social Security. They can file for loans at the bank. There's a lot of things that they can do. They can file for government benefits. We can see all of that income coming in on the tax record. We can see that activity. And so we're having a lot of firms using us just as another layer of identity protection, if you will.
Right.
You're on the preventative side, and we just do this little small thing, I think,
but
here as part of that.
But if someone is going to use your service, they better take their own cybersecurity very seriously, because you're going to go from having X amount of data to about 10X amount of data the next second. And so if you get breached, oh boy, headache.
Yeah, so this is probably self-serving for you, Mark, but we might get, for an average high net worth or ultra high net worth client, we might get 100,000 data points. And this is the most extreme PII that exists, right? The IRS knows everything. They know every single, brokerage account and IRA account and, all of it. And so, it's really the biggest risk is actually at the firm level. And it's probably the biggest risk is the human factor, right? The phishing and the stuff that's going on every day in emails and so forth. That's probably the biggest risk.
Yeah. Yeah, and the Reg SP now puts a lot of liability. I mean, the SEC pulled the cyber rules that they had proposed for the prior administration because they're trying to deregulate somewhat. But Reg SP is still in place, and if you get breached and a lot of client data gets stolen, you get ready for a giant Excedrin headache. It's not going to be fun.
They're coming at you. Hey, Kevin, tell us where you see the company headed over the next 12 and 24 months, and what's new and interesting. What are you working on?
So you sort of talked a little bit about the big problem we're trying to solve. There's going to be a massive deficit of advisors. You mentioned over 100,000 advisors here over the next decade, and about 1 million CPAs that are going to be gone here in the next decade. People are just aging out, and new people are not coming in. And so, the CFP, program is not getting enough applicants. There just aren't enough new advisors coming into the business. So I personally think the only way we're going to be able to solve this deficit of advisors and tax professionals is to get better data more efficiently and to render AI, to obtain the insights and maybe more efficiently evaluate that data. And so everything we're doing is revolving around that. How do we help advisors get better data? How do we help them scale advice? And how do we help them grow? It's those three things. And so right now we've got, we just released a new lead gen solution that's built on top of this nucleus. So firms can go ahead and use this with prospects and existing clients to get all this data efficiently and then go back and put it through their enterprise, systems. And
this has got to be an enormous time saver for people that are growing rapidly organically. I mean, because you take out one of the functions and just grab the data instead of the other craziness you have to do.
Yeah, I mean, what's the standard process, right? 72 pages of data gathering forms and, get the last 3 years of tax returns. That's a miserable process.
Let's scan them,
right?
and then put them into the system, and then let's do this, and let's do that.
And oh, by the way, the client's going to miss a bunch of it anyway.
Right.
So it's just creates an inefficient process. So that makes sense. The future will be much more streamlined, much more comprehensive, and enhance the advisor value proposition.
Yeah, someone asked me last week, Ray, how much time do you think our platform saves the average advisor? And I didn't know how to answer it because most advisors have had these clients 20 years and still only know where a third of the assets and accounts are.
Right.
So maybe the answer is 20 years. I don't know.
Yeah.
We figured out in 60 seconds.
Yeah, that's pretty interesting. Mark, what else do you think? We've talked about a growing trend among high-performing teams and advisor practices where they're introducing tax services into the equation. This is that on steroids.
Yeah, I don't know how you not have this information, okay? That to me, it's like kind of, you're sort of ignoring stuff if you aren't doing this. And the other part is the efficiency side. Now, the bad news is that, picking an advisor is like picking a pilot. You don't know if they know what they're doing until the plane crashes. So there will be a lot of people that won't do this, and it won't be figured out. It'll take a long while till market forces catch up, which is way down the road. That said, the firms that are growing, which is about 30% of the industry right now, they're growing organically at a material rate. They can see this as critical just to efficiency, if nothing else, much less the quality of the advice. And over time, eventually, quality advice catches up, in my experience.
No doubt. And Kevin, I think the only other question that's playing for me that I think our audience is going to be curious about is, okay, you gather all this additional information, it's enhanced your value proposition, you're saving a bunch of time, providing higher quality advice and guidance, that's the the value proposition. How are you seeing advisors charge for their services differently or about the same?
Well, that's interesting. So we run the gambit with type of firms we service, from the ultra high net worth, single family and multifamily offices, all the way down to the regular Joe RIA and advisor and broker dealers and financial institutions and trust companies, everybody in between. I think we're going to start seeing a trend, as I think Mark, you really talked about, of hey, it's not a lot different serving $1 million client versus a $5 million client. But as soon as you get into the family office space, it is different. Some of them charge basis points. Many of them charge a fixed dollar fee every year, and that may be millions of dollars because it's an ultra high net worth family, but it's very easy to articulate the value that's being rendered based on the time spent and the resources and the people. So I think there is a high probability that it may shift, at least in the higher end of the market, more towards a retainer model. I think we'll continue to see folks charging basis points for as long as possible because it's simple and easy. But I don't think it translates well with all the other services that are going to be rendered.
Yeah, I mean, you'd be out of your mind to get out of the basis point thing if you didn't have to, because you get this natural inflator every year. And yes, ultimately, maybe it catches up. I think you'll see the retainer thing there. What I do think you'll see is, rather than change that model, you just expand the services you do for the same basis points. And that's starting to happen. And this is an example of that. I think, and if you, as you do that, if you don't have access to this information easily and efficiently, boy, that's going to be hard to do.
Yeah, you'll be priced out more in terms of the value you provide. That's great.
It would be really interesting to see someone come up with a value provided pay structure, right? If you save the client $1 million in taxes, maybe you get a piece, right? Like the attorneys.
I've been hearing that for years. I candidly, though, just give me the basis points, because I know that over time, I'm going to go up faster than inflation by about 5% a year. And candidly, the workload goes down.
So, Mark, maybe the answer is we start charging basis points based on these other services, not based on the value, right? Asset management may only be worth 25 bips.
Yeah,
what is it? Estate planning, tax planning,
if I'm sitting in the seat as an advisor, I like my model. I'd
Fee,
rather just add
keep
more
it
services
simple.
and keep everybody happy.
Yeah, but I think you do have to document how are you earning that fee.
Demonstrate your value. Absolutely.
Yep. So, hey, Kevin, anything else you'd add before we wrap?
How do people connect with you, Kevin?
Yeah.
So they can certainly just email me. It's kevin@taxstatus.com, or they can go right to the website and reach out. www.taxstatus.com.
Great.
All right, terrific. Hey, thanks for your time, Kevin. Appreciate it.
Thank you both. Appreciate you having me, and great show.
Terrific. Hey, Mark, anything else before we wrap up?
No, looking forward to seeing you later in the month at your event and next month's podcast.
All right, well, terrific. Well, thanks for your sharp insights today, bold predictions, and pulling a 10, 11-year-old story out of the past to make something, you've got to be kidding me, worth interesting. What I appreciate most is how these perspective forces you share cause us to pause and really consider what's really at play, not just what's happening now.
I think better, but that's okay.
Yeah, well, that's a little
As
bit
always, it's good to have a grown-up on the call doing the podcast. Thank God for you, Ray.
For all of you listening, I hope today's session sparks new thinking about how you're preparing your business for the future. We're grateful that Kevin Knull from taxstatus.com joined us. Contrasting viewpoints are valuable only if they lead to better decisions, stronger strategies, and more intentional leadership. We will continue the series with more voices, more perspectives, but the challenge for each of us is the same. Take what you heard today and think about how to apply it to the real work of building sustainable, client-focused firms. Again, everybody, thanks for joining us. And until next time, onward and upward.